the Citis, the Wells Fargos, the Morgan Stanleys and Goldmans and so on, they manage enormous amounts of discretionary money. How much gold have they got? None. Analysts are saying we think gold will go to $6,000 or $5,500 or $7,000 or whatever, effectively being cleaned out of the futures market. You've got the forward market in London. I think on balance, they're okay in gold. They're not in silver. They're short on COMEX but long in London. You get far higher bond yields and far higher gold prices. The gold prices reflecting far less purchasing power for the dollar, the euro, and also the yen. We are facing the end game. If you look at open interest on COMEX in silver, it's the lowest it has been for more than 20 years. If you look at open interest in gold, it is lower than it has been since around about 2004. Now, these banks don't take delivery out of the Shanghai Gold Exchange. It remains within the vaulting system. You know, there is a shortage of gold. It's as simple as that, and it's disappearing. The banks are rationing gold, physical gold deliveries.
In the past, you have cautioned us that international holders, specifically non-G7, have been grabbing for gold and other precious metals hand over fist, something to the tune of more in the last 60 years net purchases than more in the last 4 years than the previous 60 years combined. For the last 2 years in a row, the end-of-year survey by the World Gold Council surveying the sovereign level, in other words, the country level managers of assets, has shown the reason given for their insatiable appetite for gold recently to ensure against catastrophic monetary risk and because of a breakdown of trust and ensure against volatility. Can you talk to us about, because you just mentioned the reflex for each country to revert back into its own domestic cash in terms of safe haven, but if all the fiat currencies of the world are like a team of skydivers and they're all falling in unison, some to varying degrees, pulling in their arms isn't going to stop their drop towards the hard ground. Talk to us about the role you anticipate gold has been playing and will continue to play, and in what form in this next chapter.
Yeah, well, the central banks, many of whom have seen this coming, I mean, particularly the Asian hegemons, they've seen this coming for a long time.
International gold demand is quietly rewriting the global risk map. As Alasdair MacLeod points out here, non-G7 countries have bought more gold in the last 4 years than the previous 60 combined, signaling a shift in sovereign hedging strategies. The World Gold Council shows their reasoning is less about speculation and more about safeguarding against catastrophic monetary risk and eroding trust in fiat systems. When all currencies fall in unison, domestic cash offers no real refuge. Next, Alasdair MacLeod discusses how central banks, particularly in Asia, are positioning for this evolving monetary chapter.
And they've also informed the entire global south that this is coming. So the result is that central banks around the world, with the exception of America and the European nations, I mean, the Brits, the French, the Germans and so on, have been accumulating gold as a greater proportion of their overall reserves. So that makes sense. Now, I would draw a distinction between the relationship between individual fiat currencies and the relationship with gold, which in everybody's common law is real money. There is not enough gold around, if you like, for everybody to get out of a foreign currency and use gold as safety. And also in pure accounting terms, of course, going into gold for a fund manager actually does provide risk because it could go up, it could go down from his point of view. So I think, that gold is almost sort of standing aside from this. And at the moment, it's being driven by other factors. We've had a very substantial shakeout in gold and silver since January, the January peaks. On that basis, you would have thought that, first of all, speculators would leave the market, but they weren't really in there in the first place.
Central banks outside the G7 are quietly stacking gold, but it's not a total hedge. As Alasdair MacLeod points out here, their accumulation increases gold's share of reserves. Yet there's simply not enough to cover global exposure. Speculators have been minimal since January peaks, highlighting that price swings are driven by structural demand, not panic trading. Fund managers still face risk accounting for gold's volatility. Next, Alasdair MacLeod shows how gold stands apart from conventional currency dynamics and continues to reshape institutional strategy.
There was very little speculation, actually. Secondly, you would think that demand, if you like, for physical gold and silver would decline because the steam is taken out of the market, but not at all. I mean, I don't know what you're seeing in America, but certainly what's going on in China is still very, very strong demand for gold and silver. The banks are rationing gold, physical gold deliveries. And only this morning I saw that the Chinese Construction Bank, instead of doing the rationing, like a sort of at 9 o'clock in the morning, if you're there at 9 o'clock in the morning, literally by 1 minute past 9, it's all gone. That's been the situation. So what the China Construction Bank is doing is now running a lottery system. You pay your money in to buy gold, and it's like getting a lottery ticket. You may or may not get it. You probably won't get it. I mean, the point about it, which I think is desperately important to understand, is that the Chinese do understand that gold is money. We don't. We've forgotten that in the West. There is also a very, very strong savings culture in Japan. I mean, overall savings are reckoned to be about something like 40+%. But if you strip out the industrial investment, you're left with household investment of somewhere between 30 and 35%. That is, in dollar terms, an accumulation of between $5 and $6 trillion every year. So where does it go? Well, property is dead. That's of no interest. The stock market is of limited interest, let's face it. It's only recently just about doubled. But really, that's just catching up with what was going on elsewhere. What they've been doing is, I mean, the banks have been holding on to deposits by coming up with innovative means of trying to produce a better rate of interest. But at the same time, the People's Bank of China has been reducing its interest rates. So the returns on a bank deposit are very low. But all these banks offer a gold accumulation account which can run alongside your deposit account.
China's gold demand is hidden in plain sight, masked by lottery-style allocation and rationing. As Alasdair MacLeod points out here, speculation is minimal, yet physical demand remains extremely strong, with the China Construction Bank issuing gold via lottery within minutes each morning. Japan mirrors this with household savings injecting $5 to $6 trillion annually into gold, bypassing underperforming property and stock markets. Investors often miss how these systemic savings patterns quietly underpin global gold markets. Next, Alasdair MacLeod unravels the implications of this structural demand and the disconnect with Western perception.
So, for a minimum payment of something like 500 yuan, which is less than $100, you can open a gold accumulation account, and you can put in a standing order to transfer from your deposit account to your gold accumulation account so much per month. You can see just how enormous, with net savings of, sort of in the order of $5 to $6 trillion every year, what an enormous impact this is going to have on gold. And we're seeing it already. We really are seeing it already. Now, these banks don't take delivery out of the Shanghai Gold Exchange. It remains within the vaulting system, so we don't actually see how much gold is actually behind these accounts. I don't know whether they're 100% backed or not. I have no idea at all. I mean, if they run under normal banking prices, under a normal banking system, then they would probably have a leverage position insofar as they would back the position with about 10-15% of gold or something like that. Now, that would be unallocated way of doing it. But having said that, that only really works with credit in your own currency, where everything is measured in your own currency. So, there is a shortage of gold. It's as simple as that, and it's disappearing. And I think that to some extent, the price in China on the Shanghai Gold Exchange and also on the Futures Exchange is actually being set in the West. So we're suppressing the price in our paper markets, which is leading to price suppression there. If that price suppression wasn't there, I would fully expect gold and silver to be far higher. I wouldn't speculate how much, but they would be far higher. So that, I think, is the background for gold and silver. The other thing I would mention, which is interesting, is the complete lack of speculative interest in the West. Excuse me, I'm getting over a cold.
The goal behind Chinese accumulation accounts is largely invisible, giving Western markets a misleading sense of liquidity. As Alasdair MacLeod points out here, unallocated leverage and suppression in paper markets mean actual gold availability is shrinking while demand explodes. With $5 to $6 trillion in annual household savings flowing into these accounts, global physical supply is quietly tightening. Meanwhile, Western speculation remains almost non-existent, creating a disconnect between perceived risk and real structural pressure. Next, Alasdair MacLeod discusses how these hidden dynamics in Asia fundamentally distort global gold pricing and investor strategy.
If you look at open interest on COMEX in silver, it's the lowest it has been for more than 20 years. If you look at open interest in gold, it is lower than it has been since around about 2004. These are, by any measure, heavily oversold markets. When we say oversold, what we really mean is that the level of speculative interest is zero, just about zero. Now, I know there are positions, but they are pretty firm positions, and any move to reduce prices from here is likely to be met with buying. So overall, this situation now, I think, is ripe for a pretty good move in gold. I would say there's one little caveat that I would put in all this. And that is that if I'm right about the Wile E. Coyote situation hitting Japan first, or maybe someone else first, particularly America, then markets are going to crash. In a market crash, in all that pandemonium, there will be a markdown on gold. I wouldn't bank on it. I would hope for it, because as a stacker.
COMEX silver. Open interest is at a 20-year low, a signal that is often misread as a lack of demand rather than structural scarcity. As Alasdair MacLeod points out here, gold. Open interest is lower than any time since 2004, yet firm positions indicate that buyers are waiting on dips. Oversold markets can trigger rapid price rebounds when panic or realignment hits. But global shocks, like the Wile E. Coyote scenario affecting Japan or the US, could temporarily suppress gold despite strong fundamentals. Next, Alasdair MacLeod discusses how these structural pressures may create asymmetric opportunities in precious metals.
My goodness, what an opportunity. But it would be driving things in completely the wrong way. And the reason I think this could happen is that recently I've noticed that the market has been marking gold up when the US Treasury yield drops a little bit, marking it up when the dollar's trade weighted drops a little bit, and vice versa. This is just nonsense. It's complete nonsense. It's a complete misunderstanding of the role of gold compared with credit, which, of course, is really represented by fiat currencies. It is, if you like, the macroeconomic establishment's response to market developments, which just shows their ignorance, real ignorance about the relative position of gold, what gold's function is in a monetary system. They should be looking at the risk in the whole system. And what you're going to get is you're going to get far higher bond yields and far higher gold prices. The gold prices reflecting far less purchasing power for the dollar, far less purchasing power for the euro, and also the yen. We are facing the end game for the fiat currency system. And unless that is stopped, and I can't see how it will be stopped, that basically means that these fiat currencies become completely valueless, which in gold terms means it'll be priced in these currencies. Gold will be infinite in terms of price, but in value, probably not too far away from where we are here.
One of the things you mentioned along the way there is this counterintuitive knee-jerk reaction during market collapses out of all assets other than the local currency, including, in that case, there could be a time of a big markdown in gold, which would be counterintuitive and, frankly, the opposite direction that would actually be productive for people who are really seeking true shelter. Mario Neko, who I'm sure you're acquainted with as well, talks about the counterintuitive movement of the tide when a tsunami is occurring.
Gold's recent movements against Treasury yields and the trade-weighted dollar reveal a deep misunderstanding of its monetary role. As Alasdair MacLeod points out here, the macroeconomic establishment misreads gold as a reactive instrument rather than a systemic hedge, exposing fiat currency vulnerability. Endgame dynamics suggest that bond yields will rise sharply, and gold will reflect declining purchasing power across dollars, euros, and yen. Counterintuitive price reactions during collapses could momentarily mislead investors. Next, Alasdair MacLeod shows why understanding these anomalies is critical for long-term wealth preservation and strategic positioning.
There's been an earthquake, the tide goes out rapidly. I mean, not just rapidly, but astonishingly. And all the crowds come out and they gawk and they go, my, where's all the water gone? And then by the time they see the wave coming back, it's too late to reach high ground, to reach safety, when nature reasserts itself in a way that maybe a little bit more intuitive, but extremely dangerous. Also, in passing before, you mentioned asset managers and endowment managers basically not seeing the reality of protection and hedging in gold in the West. You talked about the G7 and the G7 versus the incredible savings rate, including physical gold savings rate in Asia and so on. Can you contrast the exposure that ordinary moms and pops in the U.S. are likely to be left in the West, in the G7 countries, if their pensions, their retirement savings, their 401ks and so on are in the hands of these current generation of endowment managers and asset managers, and where that leaves us in the West?
Well, the answer basically is, for all intents and purposes, they don't hold any. We're looking at portfolios which are worth, 330 trillion or something around the world, with a very, very heavy weighting on the United States. And when you talk to the big banks in America, the Citis, the Wells Fargos, the Morgan Stanleys and Goldmans and so on, they manage enormous amounts of discretionary money for high net worth individuals, ultra high net worth individuals. How much gold have they got? None. Yet their analysts are saying, we think gold will go to $6,000 or $5,500 or $7,000 or whatever. They're all forecasting higher prices for gold. Yet, for their managed accounts, they've got none. It's an extraordinary situation. They need to remedy that.
Western asset managers and endowment funds are dangerously underexposed to physical gold, despite predicting enormous future gains. As Alasdair MacLeod points out here, portfolios across the US and broader G7 are heavily weighted in conventional assets while ignoring systemic hedges. This leaves everyday investors and retirees at risk if a crisis unfolds, as liquidity and protection in gold are minimal. Analysts forecasting $6,000 or $55,000 gold have no skin in the game, exposing a stark credibility gap. Next, Alasdair MacLeod discusses why this lack of actual holdings could trigger a sudden scramble and sharp price moves.
So you will see that by the time they start trying to buy gold for their discretionary clients, there will be very, very little left. And you'll find the gold price will rise really very, very sharply if they start buying. So it's going to be a big problem. They're effectively being cleaned out of the futures market. You've got the forward market in London where liquidity, I mean, basically, I think on balance, they're okay in gold. They're not in silver. When I say okay in gold, they're short on COMEX, but long in London. So, net long, they're quite happy with that. But they don't want to go short. That's absolutely clear. And this is really, we saw the markdown in gold in recent days. That's all to do with the expiry of the April contract, which was the active gold contract. That is now pretty much out of the way. So we're now going to see, I think, quite clearly, demand returning for gold, driving prices up. Nobody's got it. They've got to buy it, yet there's none available. So where does it go? There's only one way.
The moment asset managers scramble for gold, supply constraints will turn small buying into sharp price spikes. As Alasdair MacLeod points out here, discretionary accounts face a severe shortage, with futures cleaned out and London net longs masking the real scarcity. The April contract expiry temporarily suppressed prices, but with demand returning and physical gold unavailable, even modest buying pressure could trigger dramatic upward moves. Investors ignoring this disconnect risk being late to the party.